So as promised, we did part one of this portfolio risk and return introduction, or the math, the portfolio math here. So now we've got part two, and we're going to head off into that and see what we can learn. So here's the way this is generally going to work, or has worked. What we've done so far has been what I would identify as portfolio theory, meaning that we were looking kind of in a Markowitz framework. We did some discussion of what was mean and what was variance, and we worked our way up to being able to think about correlation and the variation of a portfolio and the importance of correlation in determining the variance of a portfolio, and we got to where we did the Markowitz efficient frontier. Then we said, okay, what happens if we take a risky portfolio or a risky asset and combine it with the risk-free rate? And what we get is, when we do that, is what you see in front of you. So we have this risk-free asset down here. Remember, the risk-free asset has zero variance, but it also has zero covariance with all other assets. So if we take the risk-free asset and we combine it with just any risky portfolio, doesn't matter, there's nothing special about this portfolio in this graph. We're, again, just in the risk-return space. If we take it and we combine it with we take the risky asset or risky portfolio, combine it with the risk-free rate, then the combinations of those two assets, RF and RP, are going to lie on this straight line, right? So if you do 50-50, half in the risk-free asset, half in the risky portfolio, well, you're just going to be in the middle, and your risk is going to be cut in half, and your excess return will also be cut in half. You'll end up halfway between the return on the portfolio and the risk-free rate. So here's our formulas. So if we're looking at expected return, it's the weight on the risky times the return on the risky, the weight on the risk-free times the return on the risk-free. So that's always the case. There's no synergy to return. There's no diversification in return. So return is always going to be the weighted average of the individual assets. Okay? And for the standard deviation, since this has no standard deviation and no covariance, all we have to do to find the standard deviation of the portfolio is take the weight allocated to the risky asset and multiply it by the risky assets portfolio, or the risky assets standard deviation, excuse me, and that will get us the weight of the risk of the combined portfolio. All right. So it all lies on the straight line, and we extended it up this way, and we said, oh, this is a CAL, a capital allocation line, and you can calculate a CAL as a function of a risk-free asset and any other risky asset. So we could have chosen any point, right, just to make clear. So if this is one CAL, right, it's the combination of this particular risky portfolio. Well, we could have also had a risky portfolio here, and we could have done the same thing. Or we could have had one here, and we could have done the same thing. So this will apply to the combination of any risky asset and the risk-free rate. And that's going to become an important point in just a moment. All right, so what we're seeing here is multiple CALs. So we have point C, point B, and point A. Well, if we look at these three portfolios, and the idea is this. Look, I have these three portfolios, A, B, and C, and they all represent different trade-offs between risk and return. And I want to optimize my portfolio. I'd like to have the returns of A, but I want something like the risk of C. Well, if I could form a CAL based on C, and I could have any combination on that line, okay? Or I could form a CAL with A up here and have any combination on this line. Okay, well, the point is, it's really important to recognize that any point on CAL A dominates CAL B, right? So in other words, other than the intercept over here, where we're 100% in the risk-free rate, if we're going to do any portfolio combinations, we're always going to be better off taking the risk-free asset and combining it with portfolio A, because it gives us the steepest slope on the CAL. Why is that? Well, let's suppose that this is our risk budget. We just can't do any more risk than that. Well, the choice is, do you want this much return for bearing that much risk, or do you want this much return for bearing that much risk, right? So the steeper the CAL, the better the risk-return options. And what we're ultimately going to show in just a little while, or at least point out, it will be on the slide, is that the steeper the slope of the line, well, the slope of the line is going to be the Sharpe ratio. Okay, and the steeper the slope, okay, well, that's going to give us a higher Sharpe ratio, and what we want is the highest Sharpe ratio. So you've seen the Sharpe ratio elsewhere. We'll be able to use it a little bit more in just a little while. So risk-return combinations, this is taking any risky asset, combining it with the risk-free rate. Okay, once we do that, we form this straight line capital allocation line. Okay, well, the steeper the line, the better the portfolio choices. So what your goal is as a money manager is to find the steepest CAL that you can possibly get. And what that means for you is it doesn't matter what the risk and return prospects of your individual portfolio are, right? Whether you're up here or whether you're down here doesn't matter, because we can lever up and down along the CAL at will, at least in capital market theory. Now actually levering up a portfolio is harder than it sounds usually, but nonetheless, in this tightly woven world, we can move up and down this line at will, all right? So capital allocation lines. So this is what we're doing now is we're applying the idea of a capital allocation line, and we're combining it with Markowitz. So remember, in the last reading, we talked about, we took the individual assets, we combined them into, found their place on the risk-return space, and then we took those and combined them in 2 asset portfolios, those 2 assets, and combined them into 4 asset portfolios, and it kept pushing us out and out and out, and finally, we ended up with this Markowitz efficient frontier. Okay, well, what we're doing here is saying, look, we can choose any point any point anywhere, but if we chose something like this, maybe that's the global minimum variance portfolio, and we wanted to combine that with the risk-free rate, we could get any point along that line, right? So this is a risky portfolio, this is the risk-free asset, so we can combine them and we can move anywhere along that line. But what we need, or what we would like to have, is the most return we can get for a given amount of risk, or the least risk for a given amount of return. So what is possible from a market point of view is to say, well, let's take this and form a CAL using the Markowitz efficient frontier, and the CAL we're going to form is going to be the one that is created by the point of tangency between the risky asset efficient frontier, okay, and this straight line coming out of the risk-free rate. And that is not just a CAL. It is a CAL, it's a capital allocation line, but it is a special CAL, right? So this is the efficient frontier. So if you form the best portfolios you could form, best risky asset portfolios you could form, and then you add this risk-free rate, that's what Markowitz didn't do. We find this CAL coming out of there, again, the straight line combinations. This is the capital market line, the CML, right? Capital market line. Be careful with that. We're going to contrast that later with the SML, right? We need to make sure and keep those straight. So I'm going to put an X through this because we're not talking about it yet. But make sure you know that there's going to be 2 lines we're going to be talking about, and this is going to be the first one. Okay, so if we take this and we say, okay, this is the Markowitz efficient frontier, and we've added a few other assumptions, okay, that, homogeneous expectations. That means everyone views the world in the same way. It also has some other implications that we don't need to go into here. Okay, then we do this combination of the risky asset and the risk-free rate, and we optimize that by finding the point of tangency. Then we have found the capital market line, right? The capital market line, the slope of the capital market line is going to be the Sharpe ratio of the market, okay? And this is what we're going to call portfolio M, right? So that is the market portfolio. So if we have homogeneous expectations, everyone's going to see this, everyone's going to do it. So everyone is going to invest in some combination of this market portfolio M and the risk-free rate. This is actually a separation theorem in economics, where we're separating the decision to invest from what to invest in. So everybody invests in the same thing. Everybody invests in M and RF in some degree. If that's too much risk, you come down here, part RF, part M. And if you want more risk, then you lever up and you buy the market portfolio on margin, right? So anyway, this is the capital market line. Let me point out a couple of really important things about it. And in order to do that, I'm going to erase some of this. Okay, so it's pretty basic, but anyway, it's important to note. And it's important to note that this has a couple of properties to it, right? So first of all, notice that the measure of risk here is standard deviation, right? So if we're talking about the CML, right, then our risk measure is going to be based on standard deviation. In a little while, this is what we're going to call total risk. Okay? So if that name doesn't make sense yet, it will in a little while. So the CML is based on standard deviation, so it's expected return against standard deviation, and okay, there's 2 assets that plot on the CML. Right? One is this portfolio, the market portfolio. We call that M for market, the market portfolio, and this, the risk-free rate. So there's only 2 assets, this risky asset M, okay, and RF, and it's based on standard deviation. I point that out because we're going to get to, remember I said we're going to talk about the SML, we're going to see that these 2 things are very different. So the CML is basically a capital allocation line, right? It's a CAL. CML, it's special homogeneous expectations. It's assumes that we all view the world in the same way, all that type of stuff. Okay, so but the use of this would be to say, look, everyone's going to invest in M and RF. All we're doing now is looking at proportion, right? Are we going to be a lot M, a little RF? Are we going to be 120% M? Okay, so we're just thinking about how we're going to invest along this line. So it would be a tool we could use to allocate our capital. That is, what's the asset allocation for our portfolio going to be? If this is too much risk, well, don't buy the market portfolio on margin. If this is too much risk, then don't put all your money in the market portfolio. If this is too much risk, okay, well, then don't put half your money in the market portfolio. If this is too much risk, then you probably need a better understanding of finance. Anyway, but you could still keep moving down the spectrum until you had everything in the risk-free rate, all right, a risk-free asset. So two things, okay, it's based on total risk, okay, and there's only two assets that plot on it. We use it to allocate capital between those two, all right, capital market line, very important construct. Okay, systematic versus unsystematic risk. So here's the notion, okay, there's lots of things that cause the value of a company to go up and down, okay, and most of those are unsystematic, all right, so the company offers a compensation to the chief executive that the market doesn't like. It gives him too much compensation and not enough emphasis on performance, and the value of the company falls a little bit. All right, or some sort of news story comes out about they did something they shouldn't have at the plant in India or whatever it was, and the value falls a little bit. Right? Those are all unsystematic factors. Okay, the company zigged when it should have zagged. Okay, well, it could also be positive zigs and zags. Right? So the company, built shiny new headquarters, and they said they're building for the growth they're anticipating, and people believed them, and the value jumped up. Okay, so unsystematic factors. These are also called firm-specific factors, right, or firm-specific risk. Well, the point is going to be this, right, that total risk, right, what we've calculated as standard deviation, I'm going to call it TR for total risk, okay, is going to be equal to systematic risk plus unsystematic risk, all right? So systematic risk, this is the risk of the market, okay, and this has to do with changes in the market or factors that impact all or almost all firms. So, a recession. Okay, a big change in interest rates, change in the tax code, some sort of a supply shock, thinking back, the OPEC oil issues in the 70s. Okay, those types of things, a war, right? Those types of things are going to impact all or almost all firms. So when we look at the risk of a firm, and if you plot an individual firm, well, you're going to see that it's all over the place. Okay, that's the total risk. That's the standard deviation. But some of that is from these things that only impact that firm, and some of it is from factors that impact all firms, right? So if you think of a company that flamed out, and the one that popped into my mind, you're too young to remember likely, is Enron. But anyway, so I owned Enron when over a 90-day period it went from $60 a share to $0 a share or something like that, right? So it went minus 100% over 60 or 90 days. I owned it when it happened. If you looked at my portfolio during that year, you'd never be able to tell what 60-day period that happened over, right? Why? Because I'm an indexer. I own 5,000 different companies, and with the same 90 days that they were burning out, I had 10 other companies that got patents approved, and someone else that got a big contract with the government, and someone else that resolved a strike with the union, or whatever it happened to be. So the effect of Enron, the lying, cheating, stealing, philandering that was going on there, was unsystematic. That was specific to that asset. It was firm-specific risk. Well, the point is going to be that this can be costlessly diversified away. All right? So when we look at total risk, okay, well, we're measuring systematic and unsystematic risk. Well, it is systematic risk that is what we can't get rid of, all right? And this is the systematic risk principle, and that is that when we look at a portfolio, we shouldn't be rewarded for risks that we can costlessly diversify away. Okay, what we should be rewarded for is just the systematic component of risk, all right? So do different firms have different systematic risk? Well, sure they do. So if you're looking at Apple, well, if the market goes up, well, Apple goes way up, right? If the market goes down, then the Apple goes way down. Well, why? Because, when everyone's 10 feet tall, bulletproof, and invisible, then everybody needs the latest $300 tech watch or whatever it is that they're producing this week. And by the way, I like Apple products. That wasn't intended to be anything negative. I've got a iPad that I refer to as my precious, right? Anyway, so I'm not, if you're the CEO of Apple, don't call me, right? That wasn't intended to be a jab. Don't call me again, I should say. Anyway, if you look at what happens with Apple, well, if the market goes up a little bit, then Apple goes way up. Okay? The market goes down a little bit, Apple goes way down. If you look at the provider of some sort of consumer or a consumer staple, right? So if you're selling bread, you're selling oatmeal, well, the market goes up, you can go up a little bit. The market goes down, you can go down a little bit, but you're not going to be as impacted by that. And the point is, what you're rewarded for is systematic risk, and not all firms have the same amount of systematic risk. So this is what we would call the priced factor, right? So this is going to be something that we want to, that should change expected returns. And we're going to come up with a model in just a couple of minutes that doesn't look at standard deviation or total risk, right? Because this part's not important. What we want is a model that is based on systematic risk, right? And that systematic risk is going to be measured via beta, right? So let's think about the diversification of risks really quickly. So if we're looking at this axis is going to be the variance, or the standard deviation of my portfolio, and this is going to be the number of assets in my portfolio. Okay, so what I'm going to do is I'm going to go out and I'm going to look at, I'm going to get 100 in one stock portfolios. So I'm going to have 100 stocks. They'll be just single stock. And I'm going to follow them over 60 years. And I'm going to say, okay, I'm going to calculate the annual standard deviation, each stock for 60 years. So, 100 stocks, 60 years, 600 observations. And I find the average standard deviation is way up here. So when I have one stock in my portfolio, I have a really high standard deviation for that portfolio. But then I'm going to go back and say, well, now let's take those and combine them into two stock portfolios. So randomly choose two stocks, put them together. I don't know what the correlation coefficient is between those two, but I know it's less than 1. So I'm going to do that with 100 portfolios. I'm going to follow them for 60 years. I'm going to find the average standard deviation. And if I have 2 stocks in my portfolio, I'm going to be down here, right? And then I'm going to go back and I'm going to put 3 stocks in my portfolio. I'm going to be down here. And I'm going to look at that after I do 3, and I'm going to think, I like where this is going, right? So because this is looking like when I get out here to about 30 stocks, I will have gotten rid of all of my risk. And you know what? I just realized I drew this backwards, right? Yes, I did. So this should be the number of assets, right? And this is going to be the risks. Let me tell you the story again to make sure we're all right on that. So if we have one asset in our portfolio, the standard deviation is going to be really high. Right? That's good, because if you were thinking, I don't know what he's doing there, why does that? Well, then you were catching it on your own. So now I'm reinforcing your good intuition. So if you have one asset in your portfolio, okay, you're going to have really high risk. If you have 2 assets in your portfolio, you're going to have a little bit lower risk. 3 assets in your portfolio, you're going to have a little bit lower risk. And when you get out here to 30, are you going to have gotten rid of all your risk? All right? Well, the point is this, right? What we see with this curve is that when we have one asset, we do indeed have really high risk. And with 2, it gets a little bit lower, and with 3, it gets a little bit lower still. Okay, but eventually, this thing starts to level out, right? So it starts to level out, and if we come over here, and this could be, there's differences of opinion about where this starts to level out. It actually levels completely out, a long way out there, and there's some discussion we could have about that. Okay, but let's think of it as something that's going to level out over here, and what we're going to see is that it kind of becomes level, which means that what? There's 2 things happening. There's this risk, okay, that we can easily get rid of, right? I mean, as we've increased the number of securities in the portfolio, all this risk has gone away. But what about this risk down here, right? Okay, well, this is the systematic component. That's the part that we can't get rid of. It doesn't matter if we have 30 or 300 or 3,000 stocks in our portfolio. Okay, well, this part is always going to exist. This part we can costlessly get away or diversify away, and depends on who you talk to, but some people will tell you this happens around 20, and some people will tell you it happens around 50. Okay, it doesn't actually get all the way down until you get all the securities in the in the world in there, but it becomes essentially an asymptote over here where you've gotten 95% of the diversification benefits or something like that. But it's a relatively small number of securities, 20, 30, 40, 50, depending on who you're talking to. Okay, so if you buy any mutual fund, okay, they own more than 50 securities, okay, well, you have diversified away all this. If you own Enron, you don't even know it when they go bankrupt, all right? But if you're holding a portfolio in 2007 that is all equities and has lots of systematic risk, you certainly know that, right? When all stocks go down together, okay, you have systematic exposure, well, your portfolio goes down with the market, right? So the point here is that, look, there's two kinds of risk, right? Total risk is this line that we see going down. That's the standard deviation. Okay, so this total risk, standard deviation, is equal to total risk, okay? And that total risk is combined, it comes from two sources. There's systematic sources and there's unsystematic sources, right? Well, these we can costlessly diversify away, so we're not interested in this total risk. The risk that you should be rewarded for bearing is the risk that you cannot get rid of. That is the systematic risk, and that systematic risk we're going to measure with this idea of beta that's going to fit into our capital asset pricing model. You can see this says about 30 securities here. So 20, 30, 40, something like that, depending on which particular research paper you're reading. There's actually applications or websites where you can go and use real data and do this for yourself and see it if you really get interested in it, all right? But the point here is, okay, as you increase the number of securities, just in a naive sense, okay, you're going to get the diversification benefits of combining securities that have less than perfect positive correlation, okay, and somewhere around 30 securities, you're going to have gotten most of the diversification that you're going to get. What you're left with, okay, is just the systematic component. So as you go from 30 to 300 to 3,000 securities, okay, this line doesn't change much, right? Change a little, but it doesn't change much, all right? So keep that in mind because that's going to become a really important story in just a moment. Let's talk about return generating models. So return generating models, this is called the market model, and all this says is, hey, we've got some data. We've got some data on security A, so here's asset A over here, right? And we've got over here the S&P 500, right? And we've got a return series. So we've got monthly returns for the last 5 years. So we can take asset A, its returns, and we can plug it into a regression equation. So this is going to be the intercept. This is going to be the return on the S&P. And this, of course, is just an error term that says that we're estimating this with error. You're going to learn more about that at level 2 when you do regression. Okay? And this is the sensitivity. All right? And what this says is, if we look at this and say, well, all right, RI is equal to, I'll call it 2 plus 1.5 times the return on the market. Okay, well, if that's the equation we estimate, we use a technique called regression that we learned about at level 2 to estimate this and this. Well, that would say, look, if we take 2 and we add 1.5 times the market return, well, 1.5 times the market return, if the market was up 10%, or if that was the market risk premium, is the way we may want to think of it eventually, but if the market return was 10%, that would be 1.5 times 10 is 15, plus 2 is equal to 17. Okay, well, the return on this security would be, the predicted return in that scenario would be 17%. That makes sense? So this is just the market model, and it's really an application, it's an operationalization, I think, of what we're going to call the capital asset pricing model. You've already seen that elsewhere, but we'll get to it in just a minute. But it's just a single factor model. It's a model that says, look, we have one factor that we are looking at, and that one factor is the return on the market. What's the market doing? If the market's up, what happens to Apple? It goes way up. It goes up by 150% of what the market does. The market goes down, Apple goes way down. Right? So that would say that the firm that has a beta here of greater than 1, that would be something that's very sensitive to changes in the market. Okay? On the other hand, if we looked at a utility company, it might have a beta of 0.6. If the market goes up 10%, it only goes up 6. If the market goes down 5%, it only goes down 3. Right? So this is going to be, the beta here is going to be a measure of systematic risk, right? So thinking back to the last slide, so rather than using total risk, what we're trying to do here is use systematic risk to think about the return on a particular asset, all right? Now we're going to come back and revisit this idea of a single factor model in just a moment. Okay, so here's a multi-factor model. These grow out of something called the APT, the arbitrage pricing theory. And what we're doing is taking the return and we're slicing off whatever the risk-free return was during that period. And we're going to explain that. This is called the excess return. So this is a very common thing in finance. The excess return, that's just the return on whatever asset or portfolio minus the risk-free rate. Okay? And then we're going to say, look, instead of just explaining that with the return on the market, okay, let's explain it with, maybe the return on the market and maybe, something for a size effect and something for, a momentum effect or whatever that happens to be. These are multi-factor models, and it just says, let's use more than one factor to explain returns. Now, there's what these factors is very hard to determine. They're easy to use on the exam because they're going to have to tell you what the factor is and what the sensitivity is. All you have to do is multiply them together. These two things together we would call a risk premium, right? So again, we would have here 3 risk premiums, not B, risk premiums. Okay. So if there were 3 elements here, this would be another risk premium. So we're just going to take the sensitivity times the factor to give us the risk premium, add them all together, and that would give us, in this model, the excess returns. So the betas are sensitivities, okay, and also called factor loadings, factor sensitivities or factor loadings, and these things are factors just like on the last slide. Okay, the market return was our risk factor. So that was called the market model, single factor model. This is a multi-factor model. And there's some hand waving that needs to go on here, but if we do that, we can take that and we can take these multi-factor models and classify them into 3 different types, right? So one would be macroeconomic models. Well, just from the name, if I could cover up the slide, what do you think would be the factors in a macroeconomic model? Well, it'd probably be based on things like macroeconomic variables, right? So GDP, inflation, tax code changes, consumer confidence, maybe, well, that's enough examples, I suppose. So anyway, there would be these big macroeconomic things. It's really based on change, okay, deviations from expectations in these macroeconomic variables, okay, but that would be a macro model. Right? We also have down here at the bottom statistical models, and this is where we let the computer choose what the factors are. And they'll take 0.6 times this variable and 0.18 times this variable and 0.2 of this, and they'll combine them together, and it'll either try to replicate a variance or a covariance and some other statistical stuff. Okay, but the interpretation of the factors is very difficult. They do get used every once in a while, but they're not out of finance theory. It's just a statistical analysis. So this isn't something that I would spend a whole lot of time worrying about. Know what they are, but I wouldn't spend a lot of time worrying about thinking through them, unless you think that's cool, in which case, when you finish the exam, then you can spend a month looking at those. Okay, the most important of these, because they're the most common, are the fundamental factor models, and that's where we're going to say, let's think about return, but let's compare it to the fundamental attributes of the firm. Fundamental attributes of the firm are what? Its growth rate, its leverage, its size, maybe its beta, its PE ratio, all those types of things. So this would be where we'd say, look, I think we can explain returns as a function of the firm's PEs, okay, as a function of size, and as a function of market risk, or something like that, beta. So we would have these different factors. We would estimate sensitivities, okay, and that would be, actually this wouldn't be beta, but it'd be, we'll call it risk. Right? So we would estimate the sensitivities, and then we would be able to plug into this and come up with an expected return via this multi-factor model. Now, the most common, or the most famous of the multi-factor models is the Fama-French 3-factor model. So this was obviously by Gene Fama and Ken French in a paper that's long ago now, and actually that has some problems. I think they both admitted to, no, I didn't say that. I didn't say that. So Ken, Gene, it's a great paper. Anyway, so it has some qualms in terms of academic research, but it gets lots of traction in the real world. And what it says is, look, if we want to explain the returns on an asset, so RI, right, that's the returns on an asset, we're going to explain it as a function of 3 independent variables. Okay, one of them is going to be size. It's actually going to be a spread between big and small firms. Okay, it's going to the book to market ratio, and then the excess return on the market portfolio. Okay, this is from the capital asset pricing model, as we'll see. So it's just the Fama-French 3-factor model. There's also a Carhart model that adds this momentum thing, which says that if they had an earnings surprise last period, that tends to continue for a couple of periods. So anyway, so the Fama-French 3-factor model, is there anything to memorize here? I suppose you should know that it's based on excess return. Okay, this is we're going to see that this is the factor in our single factor model. Okay, so it won't be hard to remember. But then the book to market and then size are going to be the other two things. And the point of this is to say, look, there are things that can be diversified away, right? That's what we talked about with our graph that was sloping down with our number of assets. So we increased the number of assets, the risk of the portfolio decreased. So there's things that there's things that can be diversified away. We are assuming those are being diversified away, but there are three factors that can't be diversified away. These are fundamental. Okay, firm size impacts return. Okay, book to market impacts return, and the excess return on the market impacts return in a way, and they move differently, okay, in ways that can't be predicted and that are going to have an impact on return. So these would be called priced factors, and if you're Carhart, we would add in a momentum variable. We could also add in a liquidity variable, but the point is these types of models generally do a better job of explaining returns than does a single factor model. That said, we're still going to end up using the single factor model a lot in the curriculum and actually a lot in the real world, probably more in corporate finance than in financial services type stuff. So let's think about systematic risk for a moment. So if we're looking at the return on the S&P over here, that's supposed to be an and sign, and we're looking at the return on, I don't want to Microsoft, Microsoft, so S&P and Microsoft. So if we go back 60 months, we get the return on Microsoft for that month, the return on the S&P. Well, the S&P had a 2% return and Microsoft had a 4% return, so we get a point right there. Everybody okay with that? So we get this paired observation 60 months ago. It's 1 month of data, and maybe we annualized it, maybe we didn't, it doesn't matter. As long as we do it the same for all of what we're about to talk about. So anyway, so we end up with this paired observation between the return on the company, Microsoft, and the return on the S&P. Right? And then we go 59 months ago and we do that again and we get another point. Right? And then 58 months and we get a point here. And then 57 months and we get a point here, and 56 months and 5 and 4, and we keep doing that until we have 60 months of data. And it looks like this. All right? So we get all of these points combined between the monthly observation on the return on Microsoft and the monthly observation for the return on the S&P. So it's just paired observations on return on a monthly basis. Well, we can talk about the statistical way of the statistical algorithm for doing this regression analysis. We do that at level 2. But if we look at this, and I'm trying to sort of get my data right here. Then if we look at this, then there's a lot of spread, okay, but we could still come up with a trend line or a characteristic line, and the characteristic line is going to be the line that minimizes the distance between the line and the points. And there's some other things to say about that, and it's about half the points above and half the points below, but not necessarily exactly half. But in this case, it might be something like this, right? So we end up with this straight line as the characteristic line of returns between Microsoft and the S&P. Well, if we look at the slope of this line, right? Well, the slope of the line here, okay, which is going to end up being our beta coefficient, you'll see in just a moment, might be 1.3, right? Well, that is the calculation of beta for Microsoft. So we're going to take the returns on Microsoft, and we're going to plot them against the returns on the S&P, and the slope of the line, what this tells me is, look, if the market goes up 10%, Microsoft goes up by a factor of 1.3. Microsoft will go up 13%. Okay, if the market goes down 20%, then Microsoft is going to go down 26%. Okay, so it's going to go down by a factor of 1.3. And when I look at this graph, I can see both types of risk. Right? So the straight line here, the slope of the line, that's the systematic risk. And the spread from the line, the fact that all the dots don't fall on the line, that's the unsystematic risk. Right? So this is what we're doing here. I thought it was easier to develop at one point at a time. That's why I did that. But if we look at, we can also do it in terms of excess returns. Makes more sense given where we're going with this. So if we do it excess return, that's just the return on Microsoft minus the risk-free rate, the return on the market minus the risk-free rate. And what we get is all these paired observations. And of course, you know, the returns on Microsoft can be negative. Right? So we would have some stuff going on down here. But what we get is this characteristic line. Okay? And when there's only two variables, return on the market, return on the asset, it's easy to eyeball, and we get this straight line, and the slope of this line, okay, is going to be our beta, all right? So this is going to be the calculation. You'll see this formula again in just a minute. I'll point it out, okay? But that is going to be our measure of systematic risk that is going to fit into the capital asset pricing model, right? So here, you're going to want to make sure that you, you know this formula for beta, the covariance of the asset in the market over the variance of the asset, okay? This is, you can also calculate that as this or this, whether or not you need those. They're not the formulas I use, but you may want to throw them on your formula sheet anyway, and if you understand the math or the arithmetic between covariance and variance and all that sort of stuff, it's relatively straightforward. Okay, there's two other things here that are going to be important. All right, so if we take two assets, right? So we're going to take Microsoft, since we've been picking on them, and they have a beta equal to, I'm going to call it 1.5, right? And then we take another company, Apple. I guess I should have used their symbol. Anyway, and they have a beta equal to 2, right? And we combine them into a portfolio. This is actually a really important point, right? So you wouldn't want to miss this because this has broad implications, right? So we combine these two things, Microsoft and Apple, into a portfolio, and they're equally weighted. Well, if we do that, then the portfolio, okay, the portfolio for, I'm going to say Apple plus Microsoft, right, is going to have a beta equal to 1.75, right? In other words, it's just going to be the weighted average of the individual betas. That's what this is saying, all right? So there's three important things on this slide. One, here's the formula for beta. Might need that on the exam. Covariance of the individual asset with the market over the variance of the market. Here's some alternative definitions for it. Okay, here is the beta of a portfolio. And it's important to remember that like return, okay, return was just a linear combination of the assets. Beta is also a linear combination of the individual assets. Okay? And then finally, as an intuitive point, the beta of the market down here, well, if we wanted to estimate the beta of the market, what that says is, look, we're going to look at the returns on the S&P versus the returns on the S&P, right? Well, when the S&P goes up 5, okay, the S&P goes up 5. When the S&P goes down 2, the S&P goes down 2. Well, this is going to be a straight line. Okay, there's not going to be any spread because it's perfectly diversified, and the slope of the line by definition is going to be equal to 1, right? So the beta of the market is always going to be equal to 1 because it's a factor. When we say the beta of Microsoft is 1.3, if the market goes up by 10%, Microsoft goes up by 13%. Okay, well, if the market goes up by 10%, then the market goes up by 10%. Right? So the beta of the market by definition is 1. Anything that has a beta greater than 1 is going to move with the market, but in exaggerated fashion. Okay? And anything with a beta less than 1 is going to tend to move with the market, but in a muted fashion. All right? So greater than 1 is sometimes called an aggressive asset. Less than 1 is called a defensive asset. Okay? All right, so what we're working with here is really capital market theory. Ever since we added the risk-free asset, so when we were just working on the Markowitz stuff, we had all those risky assets. We came up with that curve for the efficient frontier. Okay, well, that was portfolio theory. Once we added the idea of a risk-free asset, that's in my mind where we make the transformation from portfolio theory into capital market theory. And we haven't really formalized that until we got to here, but here's the assumptions underlying what we're going to see going forward. And if you look at this, wow, is this a big list of assumptions, right? So they have these investors that have a mean variance, that use mean variance diversification, that is their Markowitz efficient diversifiers. Okay, they can borrow and lend an unlimited amount at the risk-free rate. I can lend at the risk-free rate. I can buy T-bills, but when I want to borrow at that rate, it's a lot harder. Everybody has the same expectations. Everyone has this one-period planning horizon. The assets are infinitely divisible. There's no frictions in the market. That means no transactions cost, no informational asymmetries. There's no taxes, all that sort of stuff. And you can read the rest of them down here. Okay, wow, that's a big list of assumptions, right? So in the end, what we're going to do is we're going to take all these assumptions and we're going to plug them into about what would be, I don't know, 10 slides of calculus and arithmetic to get what we're going to call the capital asset pricing model, the CAPM. And I think that you've already seen that elsewhere in the curriculum if you're going straight through, but it is one of the really big concepts in finance. It's flawed, okay, but it's one of the big concepts and one of the 2 or 3 most used formulas on the exam. So the point here is to realize that this comes out of making really strong assumptions. If you make really strong assumptions, you get really strong results. That shouldn't surprise you. But that also leads us to question, well, does everyone really see the world in the same way? Watch the news one night, okay, and you'll see that not everybody sees the world in the same way. If we take all those assumptions and do a lot of hand waving in mathematics, then what we get is this capital asset pricing model. And this is the capital asset pricing model. You shouldn't have to have that on your formula sheet, because if you're prepared for the exam, you will have used it so many times that it won't be a problem to remember it. Okay? And so all it says is the return on the security is equal to the risk-free rate plus beta times this thing, which is called the MRP. Okay, the market risk premium, right? So that is the return on the market minus the risk-free rate. So if you have an expectation about what the market risk premium is going to be, you understand the beta of your firm, okay, then you combine and take the product of those two, add in the risk-free asset, and that is going to give you a measure of the expected return on the asset. So the one risk factor here is market risk, right? So, and this is going to be our loading or our sensitivity. So if the market goes up 10%, Apple goes way up. It's going to have a beta greater than 1. The market goes up 10%, a utility firm may only go up 4%. So it would have a beta of 0.4 perhaps. Okay, so beta here is a measure of the systematic risk, okay, and it's the standardized covariance of an asset's returns, okay, with the returns on the market portfolio, which is all that this is saying. So we're standardizing the covariance by the market variance here. That's what we're getting as the beta. But again, it is the same thing. Remember we did all those little dots and we got that straight line? It is the slope of the characteristic line. So the beta is the slope of the characteristic line. Given the data, you could calculate it this way on the exam, but you're certainly going to want to be able to use this. So this and the Gordon growth model and a few other things are formulas that you're just going to use so much that you don't have to worry about memorizing them, because if you've practiced enough to actually pass the exam, you will have used them so many times that you'll know them. You're probably going to be mumbling it in your sleep, and your significant other will be sick of you talking about the capital asset pricing model. Now, it's probably worth pointing out that the capital asset pricing model doesn't work, right? The world I want to live in is the one where this actually works, because intuitively it is so beautiful, but its ability to explain the cross-section of returns is very limited. Nonetheless, it is an easy starting place, and we are at level 1, so that's what we're looking for as a starting place. So we use the capital asset pricing model to come up with expected return for individual assets a lot. So it's the expected return on the security based only on systematic risk. Okay, we use it to determine the required return on an asset based on the asset's risk. So there's an important distinction here, all right? So if we go back to the last slide, it says the expected return on asset I is equal to, and then there's the formula, right? So this E is the expectations operator, right? You would read that. The expected return on I is equal to, and then there's the formula. Okay, but this is a required return model, right? So it's giving you the required return given that the beta is equal to 1.3 or whatever the beta was. Okay, it's the expected return only if the markets are in equilibrium. And of course the markets are never in equilibrium. So you got to be careful when they talk about expected return, because expected returns are frequently private expectations. So this is a required return model. So what is the required return on Apple stock based on its systematic risk? Well, you estimate its beta to be 1.3. You plug that into the capital asset pricing model. That would give you the required return. But if the markets aren't in equilibrium, which of course they never are, if the market, they're supposed to be pushing that way, but there's dynamic factors that keep getting in their way. So the markets are pushing towards equilibrium, okay, but they're not in equilibrium, so the expected return could be different. In other words, Microsoft or Apple could be overpriced or underpriced, and you would have higher or lower expected returns than what the required return is given risk. So the best way to think of this, okay, is through this middle portion here, and that's important enough that I'm going to get rid of some of this stuff so that I can point it out, so that you don't get confused when you're working problems on the exam. this is the way you should interpret the outcome, the output from the capital asset pricing model. It's to determine required return on an asset given the asset's systematic risk. It's a single factor model. All right, so CAPM, way big time important. You absolutely will be using this on all 3 levels of the exam. If you survey the Fortune 500 companies, something like 430 of them will say we use the capital asset pricing model to determine our required return when we're looking at cost of capital. So it gets lots of traction, even though, unfortunately, it doesn't work. All right, the graphical representation of the capital asset pricing model is this, the SML. Remember, we had the CML previously. Okay, so we said there was 2 things about the CML. It used total risk, that is standard deviation, and there were 2 assets that plotted on it, right? So the CML, there was 2 assets that would plot on it, and it used total risk. This is the SML, right? And the difference is now we're using beta, right? So with the SML, the risk, okay, is going to be a function of beta, right? So that's the systematic risk. And remember, in this particular little tightly woven world, systematic risk is the risk that should be rewarded. Total risk was 2 parts, right? Systematic and unsystematic. Unsystematic shouldn't be rewarded. So there's only 2 assets that plot on the CML. But when we go to the SML, at least in theory, all assets will plot on the SML, all right? So all assets plot on it because this is the risk that is priced. It's the only risk that's priced in this world. So if you find a corporate AAA corporate bond has a beta down here, right? Should have a return a little above the risk-free rate. If you look at a utility firm, it should have a risk here. That should be if you look at a firm that's like the market, maybe that's Procter & Gamble. Okay, if you look up here, this is Microsoft, and over here is Apple. Okay, well, all assets, okay, should plot on this line. And what we're going to see is that you can use this to identify mispricing, because if you have an expectation or expected return that's not on this line, so what if the asset plotted up here? Well, let's see. This is how much risk it has, right? But it's offering return up here. It should only have return down here, but it's offering returns way up here. So this is, 6% and this is 16%. Would you like to buy that asset? Well, everyone would, right? So everyone's going to see that. Everyone's going to buy it. That's going to drive up the price, and it's going to drive down the return until it gets to 6%. So these are the things that plot above the line are overpriced. And by the same token, we have something down here. This is underpriced. So you're going to bid the price up, and this is going to be overpriced. People are going to sell that. It doesn't offer enough return for the amount of risk that's embedded in that individual asset. And we're going to do an example of this just as we finish up this reading. So CAPM and expected returns, so pretty straightforward. We have a stock, has a beta of 1.2. The expected return on the market is 8%. I want to come back to that in just a second. Risk-free rate's 2. What is the expected return on the stock? Remember, here, it's what is the expected return on the stock if the markets are in equilibrium. So this is not incorrect, all right, but there's this implied assumption of equilibrium. A better way to say this is, what is the stock's required return, right? So the required return doesn't rely on the equilibrium conditions, but all we're going to do is we're going to take the formula, this is RF, plus the beta of 1.2 times the market risk premium, that's 8%, minus the risk-free rate of 2, so that's going to give us a 6% market risk premium, and then we get a required return of 9.2%. Let me point out one important thing, safety tip for the exam. I could take this same problem, right, just what you see here, and change the expected return on the market is 8%. I'm going to get rid of that. Take that out. Okay? And instead, I plug in the MRP, the market risk premium, is equal to 6%. Okay? I haven't changed the problem at all. If they give you this 6%, what they're saying is they've already taken out the risk-free rate. So, and the danger is that you're going to take 6 here and then subtract out 2 again. The market risk premium, okay, also sometimes referred to in more general discussions as the equity risk premium, but for some reason when we're talking about the CAPM, we call it the market risk premium. Then if it's a market risk premium, then it is RM minus RF. We could do it either way, right? So I haven't changed the equation, or I haven't changed the question. Beta of 1.2, market risk premium of 6%, and risk-free rate of 2. Well, I could plug in, here we go, 2 times 1.2 times 6. I don't want to subtract out the risk-free rate from the market risk premium. I only subtract it out from the market itself, right? So anyway, so make sure that you understand the data is all that point is my point. All right, so let's see, we've got all that, so I think we are good to go there. So this is the capital asset pricing model, okay, and you should be able to do this in your sleep. There's the one little thing down here. Did they give you market risk premium, or did they give you the return on the market? You got to be able to interpret the data, but that gives us a 9.2% return. That is the required return or the expected return in equilibrium. And we're going to use this to identify undervalued or overvalued securities right at the end of this reading, which is not too far away now. I know you're getting tired. So, deep breath. Everybody okay? All right. How about applications here? Well, applications, for better or worse, even though we know this model doesn't work, we very frequently use CAPM or CAPM-based stuff to evaluate money managers, right? So, so we're going to see that some of this is based in CAPM and some of it's not. What we're looking at here is the capital market line. So this is the capital market line, and in the real world, we're going to take this and we're going to, this should be the portfolio M, which is the market capitalization weighted portfolio of all risky assets, but we don't really know what that is, and that's the problem with this whole theory. But we'll do something like plug in the S&P here, right? So we plug in the S&P, and then we create this line. Well, we sometimes call that the CML. It's really kind of a CAL because it's theoretically, it's not exactly the same as CML, but anyway, that's what we would do. And that would give us a slope equal to this, right? So this is the Sharpe ratio of the market, right? So the return on the market minus the risk-free rate, okay, divided by the standard deviation of the market. That is, okay, the Sharpe ratio of the market. Actually, this is the Sharpe ratio of the S&P 500 if we did it this way. Okay? So remember, this is excess return, RM minus RF, divided by the standard deviation of returns here. So that is the return per unit of risk. Well, if we want to use the Sharpe ratio to identify great portfolios, okay, well then what we can do is just find the portfolio that has the highest Sharpe ratio. And the Sharpe ratio is just the slope of the CAL, right? So what we could do is we could say, look, here's the S&P. We could have a portfolio down here if we wanted, right? So we could have a lower risk portfolio, invest in the S&P, put some money in T-bills. That would bring us down here. But we want to know what about this portfolio? Okay, is that a better portfolio? Well, in this case, compared to the market portfolio, it has less risk and more return, so it seems like it's a pretty obvious case that it is better. Less risk, more return is always going to be better. But what we could do again is come up with the CAL and find the slope of the CAL. We actually don't have to calculate it, but in other words, we're just going to calculate the Sharpe ratio. So we're going to say, well, let's see, what's the return on that portfolio minus the return on the risk-free asset, and then divide it by the standard deviation of that portfolio. Well, if you can generate a portfolio, okay, and it's the slope of this line, but there's an instantaneous slope at that point. Okay, so it's the slope of this line. So if you can come up with a portfolio that has a Sharpe ratio equal to 0.6, when the Sharpe ratio of the market is 0.5, that says what? That says you are a superior analyst. You can generate 60 basis points of return for every 1 unit of risk, whereas in the market generally, okay, the best we can do is 50 basis points of return for every unit of risk. So one way to evaluate money managers, okay, would be to compare the slope of the CML, that is the Sharpe ratio of the market, to the Sharpe ratio that you generated with your portfolio. All right? So we're going to see several methods here to evaluate money managers. Okay? If you can produce a higher Sharpe ratio, then you are beating the market, right? And that doesn't mean you have to invest there. You can come down here, you can de-lever the portfolio if that's too much risk, all those types of things, right? Same arguments apply. So this is the Sharpe ratio. Hey, what about, we can also do this looking at this measure called M-square, all right? So here's what we've got. So this is the market, and this is the portfolio that we're looking at, portfolio 2. And we want to know, is that better than the return on the market? And I actually would have preferred to demonstrate this where it wasn't quite as obvious, meaning higher return and lower risk. Okay, but this is obviously going to be better than the market, but how would we quantify that? Okay, well, what we could do is say, look, this is the market portfolio, and it has some level of risk and some level of return. This is the portfolio we're evaluating. It has a lower risk, a little higher return, so it's pretty obvious that it's better. But how do we take that and compare it across the portfolios that are available to us? Well, what we could do is we could say, let's take this and let's lever it up. All right? So lever it up to where? Well, let's lever it up to where it has the same risk as the market portfolio. So let's move up to here, right? That means just buy it on margin until we move the risk up to here. And then all we have to compare is returns. So if we put them on the same risk level here, well, we can say, well, here's the return to the portfolio given market levels of risk. Here's the return on the market. Okay, well, that ends up being this measure that we're looking at, m squared. And there's actually an animation here I'll show you because it's better than my writing probably. So anyway, so all we're going to do is we're going to take this portfolio, and remember, we could lever it down here if it had more risk than the market portfolio, or we could lever it up to get up to here. Well, let's see. If the risk is here, the sigma of P2 is here, how much do we need to lever up, right? Well, we need to lever up enough to push it up so that the volatility increases to where we get to sigma M. So all we're doing here is saying, look, this is the excess return on the market, right? RM minus RF, so that's right here, right? So RM minus RF, that's our standard. If you have the same risk, but you can generate more return, you're better than the market. So we're subtracting that off. Okay, here is going to be the excess return on the portfolio. That's RP2 minus RF. And I did the wrong thing there, RF and RF. But now I'm going to bring this up here, right? So I'm going to multiply it by the return on the market over the return on the portfolio. So, this would be something like, 20 over 15, right? So that's going to be, 1.25, right? So in other words, I'm going to take that, I'm going to lever it up on this straight line. I'm going to multiply it by 1.25. It'll be even bigger, okay? And then subtract off the market excess return. That is what M2 is, all right? Now, people get confused with this, so let me make sure that we're on the same page really quickly. We know that we have this excess return on the market, which is simply the RM minus the RF, okay? And if we had a portfolio where we're saying, okay, here is the return, here is RM, right? So this is the market portfolio, so we'll call it portfolio M, right? And then this is our other portfolio, so portfolio 2. Okay, well now it has higher return, but it also has higher risk, right? So it's less obvious that it is a better portfolio. It may be that it may be higher return, but is the return enough to compensate for the risk? Well, what we're going to do is we're going to come up with our RF here, and we're going to have these two cows. If I can make that work. Right? And what we're trying to do is push the risk of the alternate portfolio, the manager's portfolio, to where it has the same risk as the market. So in this case, we're having to push portfolio 2 up this way, right? So when we multiply by, the standard deviation of the market over the standard deviation of the portfolio, we're getting a number here that's greater than 1. So we're pushing it up. But it could also be that, the standard deviation of the market over the standard deviation of the portfolio could be less than 1. That would be here where we had to pull it down. But the point is that this part of the equation is isolating risk. And what that means is whatever this portfolio 2 is, we're pushing it on its cow to be at the point where it has the same risk as the market. So we might have to come down, we might have to push up, but we're going to push it to the point where its risk is identical to the market. And when we do that, then all we have to look at is return. So risk and return are important, but if the risk is the same, then we can just compare return, the distance, so the excess return, well, actually, we call this the active return, but that's a story for another day. So the difference between the return on the portfolio, given that it had the risk of the market, and the return on the market, given that it has the risk of the market, okay, is this M square thing that is actually a pretty easy to understand metric. So if your M square is greater than 0, right, then you are beating the market, right? And if your M square is less than 0, okay, then you are destroying value as a money manager, all right? So, of course, all of us, when we talk about it, have M squares that are very much greater than 0. It's when we're actually asked to do it that it becomes a problem, all right? So we already talked about the Sharpe ratio. So the Sharpe ratio, remember, was the return on the portfolio minus the risk-free rate, divided by the standard deviation of the portfolio. Okay, well, that's great, and this is a measure that is fine. Remember, if we have standard deviation of the portfolio here, we're using total risk. Well, the trainer measure says, okay, we still have the excess return in the numerator, but let's look at return per unit of systematic risk. So the trainer measure changes the Sharpe ratio, and it says, let's look at excess return per unit of systematic risk. So we're looking at the CML here. Here's the market portfolio. By definition, it has a beta of 1. Okay, we want to know if this portfolio is better than the market portfolio. And again, it's lower risk, higher return. It's got to be. But nonetheless, okay, all we're going to do is say, well, let's take the excess return and divide by the beta. And if you can get a higher trainer measure than the market portfolio, okay, then you're beating the market. All right, so it's the same thing as the Sharpe ratio, only we're using beta instead of total risk. When would you want to do this? Well, the idea is you use the trainer measure when you're looking at really big portfolios, at least theoretically, and then I think we use the Sharpe ratio all the time anyway, but we would use the Sharpe ratio perhaps if we were looking at I have a friend that manages money, and he holds between 7 and 12 assets at any one point in time, and his whole point is, and he doesn't have a huge portfolio, 50 million or 100 million, something like that, but his point is, look, I have fewer positions, but I know everything about these companies, right? So, he really digs into management compensation and all these types of things. So maybe for him, maybe total risk is appropriate because he's clearly not perfectly diversified, right? So maybe this is a better measure for him because he knows he's not completely diversified. If you're talking about these big mutual funds, deca-billion-dollar funds, well, then maybe the trainer measure is better. And of course, if you get to really big funds, it probably doesn't matter which one you use because you're going to get to where the results of the analysis are almost the same. So anyway, so that would be the trainer measure. That's something I would put on the back burner. The Jensen's alpha is something you're familiar with. So we talk about generating alpha. Is my alpha as a money manager positive? Okay, well, all I'm doing is taking the return on the portfolio, and then I'm going to take off the required return given the capital asset pricing model. So in other words, you'll sometimes see alpha as this, the return on the portfolio minus the return on the benchmark, right? And what that makes an implicit assumption that the risk levels between the portfolio and the benchmark are the same. So if the beta is 1, right? So if the beta of the portfolio is 1, notice this is a beta P. It's not the beta of the market or anything, so it's the beta of the portfolio. All we're doing here is saying, look, if you have a portfolio that you're managing relative to the market, so the S&P 500, well, if you take all of the high-risk securities. So your portfolio has a beta of 1.2. Well, it's not fair to just say, oh, here, let's take RP minus the return on the S&P because you took a lot more risk. So all we're doing here is plugging in an adjustment for the level of systematic risk. So if you have more risk, well, we're going to plug that into beta as the beta and multiply that by the excess return, add in the risk-free rate, and subtract all that from the market risk premium. So this is the way you can think of it, the return on the portfolio minus the return on the market or the return on the benchmark. But we are going to take the returns and then we're going to adjust for risk. So this is a risk-adjusted measure of return, right? So Jensen's alpha, a risk-adjusted measure of return. So we've got the Sharpe measure, we've got the trainer measure, those are closely related. Okay, we've got M square and we've got Jensen's alpha. All of those would be ways that we could evaluate a money manager. And so other than the Sharpe ratio, we have the trainer measure. Trainer measure and Jensen's alpha are both using CAPM, and the other two, the Sharpe ratio and M square, are using a CML approach to evaluating the money managers. So four different ways to do it, and I think you ought to be familiar with all of them. The Jensen's alpha and the M square and the Sharpe ratio seem to be all over the curriculum. Trainer measure is a little bit less used in the real world, at least in my experience, and I think I don't see it elsewhere in the curriculum. Sharpe ratio is everywhere. You'll see that at all 3 levels. Jensen's alpha, or alpha generally, is going to be all over at all 3 levels as well. Okay, so let's do one little exercise with CAPM, and then we will be done with this reading. So here's what we have. We have these 3 stocks, right? And we have an analyst that's gone in and worked on them. So we've got stock A has a price today of $25. He thinks it's going to be selling for $27 in the future, and it's going to pay a dividend of $1. Okay, well, if I know the price today, I have a forecast price in the future and a cash flow for 1 year from now, then I can come up with a holding period return, right? So I can just say, well, look, I've got my holding period return, just like we talked about at the very beginning of this reading. It's going to be P1 minus P0 plus any cash flows that I receive divided by P0 So in this case, it's going to be, P1 is 27 minus 25, so it's going to be a $2 capital gain plus a $1 dividend. Okay, I'm investing $25 today. So I'm going to have my holding period return is going to be 3 over 25, whatever that works out to be. So that's great. This is the expected return given the private expectations of this particular analyst. All right? Now, what else do I know? Well, I know that this stock has a beta of 1. Right? And then up here I'm told that the risk-free rate is 7 and the return on the market is 15%. So I could take my capital asset pricing model and say, well, the expected return given the amount of risk, or given the markets are in equilibrium, is going to be my risk-free rate of 7 plus my beta of 1 times RM minus RF, 15 minus 7. Right, and this thing doesn't let me write down at the bottom. That's why it's slanting up a little bit. Okay, so I take 15 minus 7, that's 8. Multiply it by 1, that's still 8. Add in 7, I get 15%. All right, so what is it that I'm doing here? All right, I have a measure of required return, right, 15%, and I have a measure of expected return. What kind of securities do you want to buy? So if you say, look, given the risk of this security, I need to earn 15%. Okay, well, if I can earn 15%, then that's just justifying the amount of risk. But what if I earn 13%? Is that good? Well, no, it's not good because you're not earning enough to compensate you for the risk. So if you're earning 15%, well, that's a 0 net present value investment. You're just earning a risk-adjusted return. So what you're looking for asset A is you're looking for a stock that is going to have a return greater than 15%. So all we have to do is get out our calculator and figure out what that is. So 1/8 is that 12.5%. So no, a little 13%. So anyway, we'll see in just a minute. Oh, it's got to be less than that. Okay, so we'll see in a second. I forgot what it is. If it was Greek symbols, I'm fine. When you actually plug in numbers, that's where I get lost. Anyway, so if the return is greater than 15%, then I want to buy it, right? I want something that's going to give me more return than 15%. And if it's less than 15%, then I want to sell it, right? If I own it now, I want to sell it because the returns are not going to be high enough. And then we can do that for all 3 of these stocks, A, B, and C, because we've got prices, we've got forecast prices, cash flows, and we have the betas for each of the stocks, and then the market data, RM and RF. So if we do that, well, we get a forecast return of 12%. There we go. Good. That's the number I couldn't remember. And a required return of 15%. Well, if the amount of risk says I need to earn 15% to compensate me for my risk, do I want to buy this asset that has a return of 12%? Well, no, I'm not getting enough return to compensate me for my risk. What about the second one? Well, the second one has a required return of 13.4, but it's offering 17.5% return. Ding, 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 ding. Okay, so there's a winner, right? So that would be something I would want to buy. What about C? Well, C has a 16.6 required return, a 16.6 expected return. It's appropriately priced. So if I just need assets in my portfolio, I can park money there, but I'm not going to earn anything more than a risk-adjusted return. So what I would want to do here is I would want to buy asset B and sell asset A. Right? So, or short it or get it out of my portfolio anyway. And then asset C, I could buy that if I wanted to. I would be earning just exactly what I think is the risk-adjusted return. And that's what a typical investor does, right? An information trader is trying to make higher returns than what you see over here. An investor is trying to make just these returns, a risk-adjusted return. So looking at the SML, I can plot these 3 securities. Remember, if something plots up here above the line, well, then it's offering return that's greater than the risk. And if it plots down here below the line, then it's not offering enough return for the risk. So I want to buy above the line, and I want to sell anything that's below the line, right? So here is my asset A. It's below the line. I'm going to sell that, or I'm certainly not going to buy it if I'm in a long-only portfolio. Here's B. Well, it offers lots of return. The required return, given its risk, is over here. It's offering returns way up here. That's my winner, okay, and then C is exactly appropriately priced. So I would, I could buy it if I want to. I don't lose money, but I'm not going to make any money doing it. I'm earning exactly my risk-adjusted return for owning that security. So we buy above the line, sell below the line. If it's on the line, it's appropriately priced, and that's where we would, the assumption of efficient capital markets. If markets were 100% efficient, then every security would be on the SML. When we relax that constraint to say there is some degree of mispricing, we would think, well, most things are going to be pretty close to this line, okay, within arbitrage bounds. But what you're looking for, if you are a stock picker, okay, is you're looking for things that are far enough away from the line that you can make a profit even after transactions costs. All right? Okay, so what we're going to do here, here's the summary of this. So A is overvalued, we're going to sell it. B is undervalued, we're going to buy it. And then C, that's properly valued, and I think we've already sort of talked that to death. So to wrap things up, the CML versus the SML, I think I've already covered this for the most part. But remember, the CML, it's going to be based on this risky asset efficient frontier. So we're going to take the risk-free rate, right, and we're going to find the point of tangency between that and the Markowitz curve. Okay, that point is going to be portfolio M. And what we've done here is said, look, everyone who invests is either going to invest in portfolio M and the risk-free rate in some combination. So it's just a way to think about, well, do you want to buy on margin and be up here? Do you want to have some cash and be down here? So it's just the way we would allocate capital, right? It's a cal applied to a theoretical Markowitz structure. Then when we look at the risk, and the risk should be labeled here as total risk. So when the capital market line, okay, remember the measure of risk is total risk, okay, and there's only two assets. Okay. And over here for the security market line, risk is beta, which is systematic risk, and at least in theory, all assets will plot on this line, or maybe a better way to say that is all assets will plot on this line when the markets are in equilibrium. And it's those people that go out and search for those ones that are either above the line or below the line, okay, that force them back toward the line. That's what arbitrage does. That makes this approximately true. But in our tightly woven world, we think all of them plot on the line, except for the one that we are looking at if we're trying to come up with some sort of buy or sell estimate on the exam. All right? So CML versus SML, again, really important constructs. The SML, remember, is the same thing as the CAPM. Right? So this is just the graphical representation. This CAPM is the formula. So these two things are synonymous, and the CML doesn't have an analog in terms of, it does have an analog in terms of formula, but it doesn't come in at the level one exams in a very prominent way. So anyway, that is the portfolio theory stuff. If you haven't ever done this before, I can see that there's a lot of ins and outs, and you got to keep track of all those measures of return and different types of measurements for risk. And then, we're going into this very tightly woven world where we have these really strong assumptions and we're drawing all these straight lines and that type of thing. So it can be a little confusing. But overall, I think that this is a place where if you're looking to pick up points on the exam, so you're feeling like, wow, I need to shore up some areas of my knowledge in order to prepare for the exam, I think this is an area that you can get through fairly quickly, and since this is all based on Nobel Prize winning ideas, what you see here is going to look a lot like what you see on the exam. So in other words, it's pretty well contained material. So I think this is something you can study, spend some time on, and actually pick up some points on the exam and feel good about your study efforts as a offshoot of being able to do that. So anyway, good luck with these two readings. We still have the one more to go that's a little lighter, but nonetheless, this part one and part two of the portfolio stuff is really what I view as the heart of the material, and you're going to want to spend at least a good amount of time on those two readings.